You've heard me say it before, property investment's a game of finance with some houses thrown in the middle. But the rules of the game are changing in front of our eyes. So today I'd like to explain what's going on with lending so that you've got a better chance for getting the banks to say yes to you and lending you more. And we're going to have that chat with leading finance specialist Adam Bradley. I plan to ask him a number of common finance questions that we're asked when clients come to see us at Metropole, but I'm also going to ask Adam some of the questions you probably wouldn't even think of asking, but are important to know in today's, well, let's call it interesting finance climate. So at the end of today's show, you should have a better understanding of how to approach the game of property finance. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
As I said in the introduction, property investment's a game of finance with some houses thrown in the middle. And speaking with the clients of Metropole, finance seems to be one of the biggest stumbling blocks they've got at the moment. I mean, everyone's got a borrowing capacity, the maximum they can borrow, and everyone seems to want a little bit more borrowing capacity. So I'm looking forward to this chat with Adam Bradley, finance specialist and director of Emerge Finance based in Brisbane. Hi, Adam.
Hey, Michael. How are you doing today?
Good, thank you. Now, Adam, the world of finance just seems to be changing continuously. I know it's your full-time job to keep up with all the changes, and that's why at Metropole we always refer our clients to a finance strategist rather than suggesting they try and navigate the maze themselves, and we definitely don't suggest they go directly to the bank, and maybe we can have a talk about why we do that a bit further on. But to give our listeners a better chance of getting their loans or getting a bigger loan, let's go through some of the common questions we've both heard our clients asking. And the first one I'd like to ask you is, it seems harder to get a loan today. Are the banks really open for business, Adam?
They certainly are, Michael. Yeah. I mean, obviously, post-COVID, there was quite a lot of changes to credit policy just based on the banks retracting a little bit. But now that COVID's a thing of the past, we are starting to see the banks relax some of their policies, certainly regarding self-employed clients and different employment types like casual was really impacted post-COVID. They're open for business, but the biggest thing on everyone's mind is borrowing capacity. So that's definitely gotten tougher over the last sort of 12 to 13 months with all of the rate rises. But the actual amount of loans being approved and the credit policies of the banks, they're certainly still open for business.
Great. So some people are then asking, well, why is it taking so much longer to get a pre-approval?
Yeah, I mean, the pre-approvals are a funny one. I guess the initial answer to that is that banks don't really prioritise them. I think some of the stats came out with one of the banks saying that only 20% of their pre-approvals actually convert to a full application.
Makes sense, yeah.
Yeah, I mean, everyone's only got a certain amount of time in the day, and banks are the same with their credit team. So why would they be prioritising resources onto pre-approvals if they're only getting paid on 20% of them? So what the banks are doing now is they're actually creating two different queues. So there'll be one queue for pre-approvals and one queue for people that have actually secured a property and got a contract on a property. So the ones with the contracts obviously get prioritised because they're the ones, especially up here in Queensland, they're typically subject to a short finance clause. Or there's, skin in the game. Clients have actually put a deposit down, so they need to commit to it. So that's probably the main reason is the different queues. But also some of them have just gotten so busy. There's a lot of refinance activity happening at the moment. They just don't have the capacity to be doing pre-approvals if it doesn't actually transact.
Well, I know our policy at Metropole and yours is not to go to buy a property without a pre-approval, because really you want that assurance and you want to be able to make a firmer commitment. Having said that, pre-approvals always have conditions anyway, so it doesn't mean you're 100% guaranteed. It's still subject to evaluation and sometimes even subject to the type of property or the location, isn't it?
Yeah, correct. The pre-approval is a great way to confirm that the client is ready to go, their personal circumstances, their credit worthiness, their deposit, their income. But it's certainly the unknown is still the property that they're purchasing. So there'll always be a condition on that. And not all pre-approvals are created equal. So some lenders will do a data-driven pre-approval where it's just based on the info that we input, whereas others, it'll actually go to the credit team. So we always try and utilise the ones that go to an actual credit team, because then we know it's being looked at by a professional, not just a computer.
Now, I know some people have said, well, I've tried those online calculators. All the bank websites have got them and some mortgage brokers' websites have got them. And they suggest I can borrow a lot more money. And then I eventually speak to somebody at the bank and they say, no, you can't. So the question people are asking us is, what's going on?
I mean, they're quite a basic calculator, right? It's more of a hook, to get a client in, to put their details in, to get on a marketing platform. I'd hate to say it, but sometimes it's a user input, the data that the user's inputting. And also, it's not relying on the bank's policies and credit policies. So again, you're going to get a much better idea if you come to a broker. We can analyse your personal circumstances and figure it all out, which banks will include a bonus income or which banks will take self-employed, or how much rental income for an investment property will the bank include. So the calculators are just a guide. But yeah, I mean, that's a common misconception for sure.
Sure. And I think what you said was right, that it really is a hook to get people in. The big real estate portals now, Domain and realestate.com, have similarly got mortgage divisions. Of course, because it's a way of making extra money on people who are going there. But those figures aren't necessarily accurate in what you can borrow. So I think what's happened is over the last little while, as you've said, borrowing capacity has decreased. And that's, of course, because wages haven't gone up anywhere near as much as interest rates have, so serviceability is tightened. So one of the common questions people are asking is, what are some of the things I can do to maximise my borrowing capacity?
Yeah, no, I mean, Michael, this is a conversation we're having with clients daily because it's so topical at the moment. I mean, borrowing capacity really is a measure of income versus expenses. So it's a calculation that the bank undertakes to determine whether you are able to repay those loans. So I guess the initial one to increase borrowing capacity is to increase your income. So whether that's hitting your boss up for a pay rise or doing more work or taking on a side hustle, increasing rents if you're in property investors. So any way that you can increase your income, and also increasing the type of income. So the banks will look at, bonuses or commission income a little bit different to a base income. Yeah, and Michael, the other side of the platform is obviously decreasing expenses. So, cutting back on some of those things that you might not be using, reducing entertainment. I guess, the whole reason that the rates are going up is that inflation has peaked, and that's caused by people with excess funds to be spending more. So by the RBA increasing interest rates, it diverts more of our disposable income into our mortgage as opposed to into inflationary measures. There's also a lot of things that we can do from a finance perspective. So we can assist clients with consolidating lending or other personal loans and non-deductible loans into their mortgages. We can extend their loan terms if they want to try and increase their borrowing capacity. We can close out credit cards or car loans or pay out HEX debts. We can convert from interest only to principal and interest. Obviously depends on your strategy, but these are all areas that we can, or levers that we can pull in order to maximise borrowing capacity. It also depends on the lenders as well. So it might entail a different lender mix. One lender will give you a certain amount, but then another lender may give you some more depending on their credit policies.
And that goes back to what I said right at the beginning, where I think people should be speaking with a finance strategist, because if you go directly to the bank, they're not going to tell you that the bank down the road with the yellow logo is going to actually give you more serviceability, higher loan than the one with the red logo. So really, you need somebody independent who has got access to multiple sources of funding. Now, interestingly, you mentioned credit cards a moment ago. I know some people are thinking, well, yeah, I've got a couple of credit cards, but that's okay. I clear them every month, so I don't really need to cut back on my credit limit, do I?
Again, we get this with a lot of clients, and I mean, it's great to be paying them off every month because the interest rates are quite high. But I guess the way that a bank looks at it is the bank could give you a loan, and then what typically happens is that clients go out and buy furniture or buy a new car, or they set up or deck out the new house. So, there's a minimum repayment on a credit card every month. So regardless of what the balance is at the end of each month, that could actually be racked up to its maximum. And so the banks will actually include that minimum repayment. It's about 3 to 4% of your credit limit. and they'll actually put that or mark that against you from a borrowing capacity perspective. So, I mean, for every $1,000 in credit card limit, whether it's paid off or not, it actually reduces your borrowing capacity by about $6,000 to $7,000. So there's a lot of people, floating around with cards getting points and, overseas travel and things, and they might have 20 or 30,000 in credit limit, which is hindering their borrowing capacity by a couple of $100,000.
Yeah, they don't realise that. Okay, what about self-employed people? Are the banks still happy to lend money to people to buy an investment property or a home if they're self-employed?
Yeah, well, that's probably one of the most exciting changes that we've seen now that COVID has finished, is that, now that the job keepers and the cash flow boosts are finished up, a lot of the banks are coming out with what they call simplified self-employment verification. So in some instances, if clients are paying themselves a wage or drawing a salary from the business, they're using that as a bit of a simple method and not sort of digging and trawling through tax returns. So we're doing a lot of that at the moment. And again, we get a lot of clients coming to us saying that their bank won't lend them money. And again, different banks are more open for business for self-employed clients. So that's where we get quite a lot of success by, taking clients to lenders that are more open for self-employed lending.
Okay. Another question at the moment with the cost of new housing or housing established properties going up as well is, I actually don't have a full 20% deposit. Should I consider lender's mortgage insurance, even though it's a cost to me? Well, let's first explain, Adam, what lender's mortgage insurance is and who it protects and who it doesn't.
Yeah, so lender's mortgage insurance is a cost or a fee that the bank charges the client, and they effectively take out an insurance policy against that loan in case the client defaults on the loan. So it protects the bank, but the cost is passed on to the client, and it can be quite significant, 2, 3, 4% of the purchase price. It's a once-off fee, but in most cases it can be added to the loan as well, so it's not coming out of pocket from the client.
Yeah, that's a good thing. And if it's an investment property, it is a cost of borrowing and it's a deductible cost. So I guess it really depends if it gets you into the sort of property that you really want to, whether it's an investment or your home. So in my mind, it's a cost of doing business. But in fact, how much you borrow or how little deposit you put in does make a difference, doesn't it? So if you keep your loan to value ratios below 90%, it's cheaper than if you go with an even smaller deposit.
Yeah, correct. It's a bit like insuring a house. The more you insure it for, the higher your premiums. So the more risk there is to the bank, the higher the LMI premium is. But it really comes down to an opportunity cost, I guess. And that's what we discuss with clients is, with the cost of living going up and wages not following, I mean, it is tricky to save up extra deposits, especially for people getting into their first or second or third property. So, it might be an opportunity cost. Does it allow you to purchase a property maybe in a more premium location and get into the market quicker to take advantage of that capital growth rather than waiting for the full 20% deposit just to save, a couple of grand in lender's mortgage insurance?
Well, nowadays there's a question, has the property markets bottomed? And there isn't one property market, and the bottom isn't a particular day or a week or even a month. It's a process. But there's no doubt that in some areas, property prices have gone up for a couple of months in a row, particularly the more affluent suburbs of Sydney and Melbourne. And so, yes, waiting longer may mean you've got to pay more down the track and you're not going to be able to save as much. So it's definitely worth considering and doing the figures backwards and forwards. Now, again, I think maybe we should quickly say that this is general advice. We don't know the listeners' specific circumstances. At the end, I'll leave some details of how they can have a chat with you and your team if they're interested in finding out more. But some people would be wondering, well, should we fix interest rates? Now, I've learned way back in the early 90s when interest rates went up very high, the concern that one can have and how important cash flow is. And so I've always fixed a portion of my interest rates, but let me say that I usually get it wrong. So you don't actually have to fix just to beat the banks. It's a way of, I guess, protecting your cash flow, particularly if you're an investor. But last year I actually did get it right. I fixed in February 2022, and I got 5-year fixed rate mortgages at a very, very low rate. So I'm looking very comfortable at the moment. But people are wondering, hey, I'm reading all about this. Interest rates may go up again. They may not. what would your thoughts be if somebody asks you, should you consider locking in on a fixed rate today?
It's a very topical question at the moment. And, again, post-COVID, the fixed rates were at historic lows, and they were actually less than the variable rates.
Yes.
So we were doing a lot of fixed rates for clients, and maybe even a split loan where you can have a bit of both, have your cake and eat it too. At the moment, though, the fixed rates are quite a bit higher than the variable. And coming back to some of those comments you said, the fixed are great when it locks in your repayments. You have certainty on what your repayments are and your outgoings. But it does restrict you with some of the repayment flexibilities, or potentially having an offset, or being able to make a lot of additional repayments. So, I guess it just depends on your personal circumstances, but we always sit with clients and look at what's actually valuable to them. And I mean, the fixed rates are still building in a couple of extra rate rises. So for clients locking in at that rate now, they're effectively hedging that the rates will go up a few more times and stay at that position for the next couple of years. And I don't know about your economist, Michael, but a lot of the ones that we're reading are potentially saying that there might be some interest rate drops in the coming 24 months. So, there's always a few things to consider when you're looking at fixed versus variable.
Well, the economists keep getting it wrong, don't they? Just have a look at and the money market seems to be as well. But the money market really seems to think that there's not going to be any more interest rate rises. And all the banks are suggesting that interest rates are going to start falling at some stage, either later this year or early next year. But the Reserve Bank doesn't know from month to month what's going on. So I think flexibility is important. Interest rates are important. But the question is, are you going to upgrade your house? Are you going to move? Are you going to sell that investment property? What happens if I actually do have fixed rates? Can I change? Can I pay back more? Can I have an offset account? So I think one of the interesting things you said that some people may have missed is, even if you've only got one loan, you can actually have a split loan where a portion of it is fixed and a portion of it's variable.
Correct, yeah. And that gives you the benefits of both, where you've got the ability to make extra payments and have offsets, but you've also got the certainty of repayments as well.
Sure. So some of the things we'd think, if you're thinking of fixing, you should ask how likely are you to sell the property during the fixed term? Because you may be able to pass it on to the next property or not. How likely are you wanting to access equity? Maybe you want to access equity from your property and do home improvements. Do you want to leverage and borrow more and buy the next investment property? Or maybe you actually, over the fixed term, wanting to make extra repayments. So there are a number of things you've got to sit down and ask. Do you want flexibility? Or do you need an offset account? All those sort of things that I think has got to be asked before you lock in. And then the next question is, how long do you lock in for? And it depends how many loans you've got, because maybe it's not a good idea to lock all of them in at the same time, because one day you're going to come out at a time when interest rates may be higher with a lot of loans.
Exactly, yeah. It's quite a personalised thing. So, I guess one of the benefits of working with a broker like us is we do consider everyone's individual circumstances and their risk profiles. And also, how much extra surplus funds have they got every month? Do they have a lot more to be contributing to a loan, or are they maxing out their borrowing capacity and they're not going to have a lot of surplus funds? So, there's a lot of things to consider.
Well, one of the things that's happening for homeowners, and particularly for property investors, is that their mortgage repayments have, well, I guess we can really use the word skyrocketed, because they have gone up 3.5% or so over the last year or two. Rents haven't gone up as much. Outgoings have gone up considerably with land tax. And if it's your own home that you've got a mortgage against it, your wages wouldn't have gone up as much as your mortgage have got. So I know a question on many borrowers' minds is, what options do I have to assist my cash flow? Because the government is trying to hurt your cash flow. I mean, that's the aim of it, to slow down spending and inflation. Are there options that borrowers have got, Adam?
Yeah, I mean, the big thing is the refinancing market at the moment. So, I read last month they're saying that refinance volumes are at record highs in Australia. And the reality is that Australians just don't review their lending often enough. So
they're lazy, aren't they?
Yeah, well, and the banks take advantage of that, right? They charge a lazy tax. So, a lot of the time the banks will offer new to bank clients a better rate than what their existing, loyal clients are paying. So
not fair.
You just got to keep them honest. So we're very proactive in, I guess, reviewing our existing client base's lending. We do that every 6 months at Emerge. But again, for clients that are listening or people listening, go and hit up your bank, try and get a better discount. And if they don't come to the party, it's time to shop around, whether that's through a broker or having a look. But, I guess that's the benefit is we do the running around. And if you can save, 0.3 or 0.4 or 0.5, you've just built in a buffer of, another 1 or 2 interest rate rises. We can also extend loan terms. So you might have been paying for 10 years. You might have 20 years remaining. You could always extend that to 30 years. It drops your minimum repayments. Obviously, if you then pay that loan off over 30 years, it ends up costing you more. But maybe as a short-term stopgap, you could do that to decrease your minimum, outgoings. You could also roll in some debt. So people have got car loans and personal loans that, although the loan amounts are quite small, the amount of cash that they suck out of your personal budget is quite high. So you could always roll those into a mortgage. So you're typically getting a cheaper rate, but again, you don't want to pay that car off over 30 years. It ends up being a very expensive car if you do that. So
you're not going to own it for that long, are you?
No.
Adam, particularly with property investors, a lot of people take an initial interest-only period, and sometimes it's 3 years, sometimes it's 5 years, and then it rolls into principal and interest, which means they've got to pay more. What are their options?
Well, that was going to be my next comment, is that you could always look at rejigging the loan to go back to interest only. Or the other thing that we're seeing investors doing is accessing some equity potentially as a buffer just to get them through this period. As we were talking about before, it looks like there might be some interest rate cuts in the next 12 to 24 months. So it might just be it's a tight inflationary period at the moment. So if you can even just get a bit of a buffer to tide you through, that might be enough to, hold on to some properties a bit more longer term.
Now, there's emails that I keep getting in my inbox, I bet you do as well, saying, hey, I got a way of helping you reduce the length of your mortgage, how long you've got it, repay your debt quicker. Do you have any ideas or strategies about that?
Yeah, there's a couple of different ways. I guess going back to the refinancing or even just renegotiating with your lender, if you can reduce your interest rate, that obviously makes a big difference. Increasing frequency of repayments, so maybe taking a weekly or fortnightly repayment as opposed to monthly. It just means you're starting to knock that loan down a little bit more frequently. You can obviously make additional repayments. That's a great way, whether that's lump sum with a bonus or some sort of sale of something to come through, or even just the weekly, monthly or fortnightly, additional repayments. You can utilize an offset account or offset accounts. Some lenders offer multiple of those. And really the benefit of those is just keeping as much funds in there as possible. And whether that's your salary or pay dropping in there every week or fortnight or month, while it's sitting there, it's reducing the interest that you're paying. Obviously, you can look at some debt recycling strategies as well in collaboration with your accountant or financial planner. So you might be able to reduce your non-deductible debt as another way to try and pay it down quicker.
Now, you mentioned offset accounts, and that's a great facility that people should be using. But another facility or types of facility people have are redraw facilities or lines of credit, and they're often used synonymously. They're all much the same. But if you're talking about investment and what's deductible and what isn't, there's a big difference between those sort of facilities, isn't there?
Yeah, correct. I guess when you're with a redraw facility, you're effectively making additional repayments into that loan. So you're actually reducing the loan balance. If you then redraw those funds back out, there is a risk of sort of muddling that debt. And maybe if you're using it for holidays or a car or something, there might be a way that debt is not necessarily deductible anymore. Obviously, It's a conversation with your accountant. But with an offset, the loan amount stays the same, but it has the same net result in reducing your interest payable. So again, it depends if it's an owner-occupied property or an investment, but we would usually utilise an offset account with clients, especially if they've got some surplus funds or looking to invest in the future.
Well, I guess the idea behind this is that it's the purpose of the loan that decides whether it's tax deductible or not as an investor, as opposed to what you're borrowing against. So if the purpose of the loan is to get a deposit for your investment property, even though the security is your home, you would have, a separate facility so that it's clear what the loan amount is that you're using as a deposit for investment, so you can make it tax deductible. But if you put some money back into it through the redraw facility or the line of credit, and then you take it out for the holiday or the jet ski, the purpose of the loan suddenly changed, hasn't it?
Correct, that's right. So it is tricky to get that set up right. So an offset account does alleviate a lot of those issues where clients can just stack their cash in the offset account and it doesn't muddle with the deductibility side of it.
Now, a lot of our investors have got a substantial property portfolio. In fact, a recent audit of our clients' results showed that they're 7.3 times more likely to own 6 or more properties, being that top 1% of property investors. And that's because they've got the right advice and they've made the right decisions. But one of the thoughts then is, once you've got a large portfolio, should you be with the one lender? Is that an advantage or is it a disadvantage?
Yeah, when we come across this a lot with clients, and I mean, at the moment, it really comes down to credit policy and also borrowing capacity. What we find is a lot of clients may use some of the first tiers for their first few properties, but then they almost potentially get capped out with their borrowing capacity. And so then if the client is continually looking to grow their portfolio, we may have to look at other options. We also want to make sure that the properties are not cross-secured. So sometimes if you're doing it with the same lender, I mean, we unravel a lot of properties that are cross-secured that have been set up incorrectly, but especially if you're looking to access equity from a property to purchase another one, you don't want the bank to be going back and revaluing your whole portfolio and then determining how much equity you can get based on the changing values of the whole portfolio.
Yep.
You might have had a property in Sydney that's gone really good over the last 6 months and you want to access that, whereas you might have had a few properties in another city that have gone down. So the net position has not changed, but obviously you want to just access the equity from the Sydney property. So by keeping it separate and potentially going to other lenders, you've got a bit more flexibility in that.
That makes a big difference. And even if with the one lender, you can make sure that the securities aren't cross-collateralized. Now, people are going to say that you've got a vested interest in the next question I'm going to ask you, and I know you have, but having said that, I think we think similarly. So the question really is, why should borrowers even bother going to a mortgage broker? Why can't I just go straight to the bank? I've always had a little loan in my credit cards with the bank. The bank officer seems a really friendly guy.
Yeah, I guess I say to clients, if the banks did their job properly, we would actually be out of a job. And now Australians are more than ever using brokers. I think the latest statistics were 70% of all borrowers in Australia are now using a mortgage broker for their finance needs. We offer choice, we offer competition, but the main thing is that we offer advice and I guess experience in which lenders are open for business and which ones are going to be most successful for your property journey. We don't charge a fee, or a lot of brokers don't charge a fee. Some may, but a lot of them don't. And, it is really tricky keeping up with the changes, day in, day out with what's happening in the market and with the lender's policies. So, we do all the running around, we do all the paperwork, and we sort of act as a bit of a buffer so that we're telling the banks exactly what they need to know in order to, get a client across the line.
Well, it is no doubt in my mind that that's the right way to go, whether it's for your home, even your first home loan, and particularly as a property investor. And while a lot of investors and home buyers are very fussed about interest rates, I think the word you used a moment ago is critical advice. The right loan is important, the one that gives you flexibility depending upon what you need in the future. So don't go to a bank to ask for property advice or investing advice. That's not what they're set up for. And similarly, many mortgage brokers start to give property advice and point you in the direction of people who give them houses and land sales or commissions for off the plan or other things too. That's the wrong way to go. So you get the right advice, the finance advice from a mortgage broker. And your team in Brisbane have recently moved premises as well. Tell us a little bit about what you do, please, Adam.
Yeah, so we've just bought a commercial property and fitted it out for the business, which is really exciting. We've been increasing our property journey, but also a bit more space now to welcome clients in, a bit more of a neighbourhood office. So really trying to tailor towards helping clients in the community and giving back to the community as well.
And where are you based?
We're based in Ashgrove in Brisbane.
And you help a lot of homeowners, not just investors.
Yeah, correct. And I guess, similarly why people use a buyer's agent is that you guys are doing it day in, day out. So a lot of home buyers, they might only be buying every 5 to 6 years. And I think the stats are that most most people buy 3 to 4 properties in their whole lifetime. So, again, we're really passionate about what we do. I love my role and I love helping people and going through that journey. And so, there's a lot of unknowns and there's lots of people involved in the process. So we really act as that conduit for clients that, of course, we're here to get their loan approved, but we work with buyers agents like Metropole and conveyancers and insurance brokers and real estate agents and things so that we can help them through the process, because it is confusing and daunting sometimes.
Very much so. Well, I think the way you answered those questions showed the depth of your understanding. So thank you very much. I'll leave a link in the show notes to Emerge Finance and look forward to having you another chat one day in the future. Thanks for your time, Adam.
Thanks very much, Michael. Great to chat.
In a moment, I'm going to share my mindset message with you, a story about the philosopher Socrates. But before I do, I'd like to ask you a little favour. If you got some benefit from my chat with Adam Bradley and you think you'd enjoy getting these podcasts and you don't currently subscribe, whichever podcast app you're listening to, just subscribe or follow this show so that you're twice a week going to get the insights from my regular guests. Now, before I get onto the mindset message, if you're got some lessons from Adam and you understand that finance is going to be important for you, it's all part of the strategic plan that we put together for our clients at Metropole. Remember, buying a property, an investment property in particular, is a process. It's not an event. It's got to be the result of a whole lot of decisions you've got to make, and finance is an important part of that decision. If you want to take advantage of the property markets as they're moving to the next stage of the property cycle, I suggest you have a chat with my team at Metropole to see what your options are and allow us to devise a customised, personalised strategic property plan for you. Why would you use us? Well, Metropole will be able to provide you with time-tested, proven frameworks that I've fine-tuned for over 5 decades. We've invested in times like this before as the market's changing. In fact, over the last couple of years, we've won multiple awards, including just recently Australia's most trusted property and wealth advisors for 2023. So if you're interested in property as an investment or for your own home, go to metropole.com.au, leave us your details, and I'd love to be part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to ask you a question. Do you have a burning desire? Well, let me explain that with a story. I read that once a young man approached Socrates, the famous philosopher, and he asked the philosopher how he, the young man, could acquire wisdom and knowledge. "Follow me," said Socrates, and he led the young man down to the sea. And the young man followed Socrates, waded in the water, first ankle deep, then knee deep, then waist deep, and finally so deep in the water up to his shoulders. Then, rather abruptly, apparently, according to the story, Socrates grabbed the man and dunked him in the water. The young man struggled desperately, and just before he blacked out, Socrates pulled him up. Infuriated, the young man screamed, "What are you doing? You're trying to kill me?" Calmly, Socrates responded, "Absolutely not. If that was my intention, I wouldn't have pulled you up." "So why then did you do that?" the young man gasped. Socrates replied, "When you want wisdom and insight as badly as you desired that breath of air, then you shall have it." He then turned to the shore and walked away. Oh, what's the lesson from this story? I guess it means you can read all the blogs, listen to all the podcasts, sign up to mentorship programs, but if you don't have the pulsating desire to be your best self, even the best strategies won't serve you. Most people are waiting for an epiphany. They're waiting for someone or something outside of them to give them the answer, or they just want a quick fix. Some people see it as happening internal, and that's different. They take action. But a lot of people seem to be entitled, and they want somebody else to do it all for them. They're waiting for somebody or something outside of them to give them the answer. So my suggestion to you is, rather than waiting, your only chance at living fully is to take action. Nothing can stop you when you decide to go all in. But you have to make that decision. I hope you start today. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?